Evening, everyone. Today I'll be discussing bond valuation, focusing on two bonds with different maturities. We'll explore how interest rate and time to maturity impact bond prices and what this means for investors. Understanding these concepts is crucial for making informed investment decisions in the bond market. We have two bonds, A and B, with same credit rating, par value, and coupon rate. Bond A has 30-year maturity, while bond B has 5-year maturity. Both bonds have yield to maturity of 6%. Due to longer duration of bond A, we expect it to have higher sensitivity to interest rate changes, which affects its prices differently compared to bond B. So which bond will trade at a higher price? Bond P with a shorter maturity will trade at a higher price than bond A, given the same yield and coupon rate. This is because the present value of future cash flows from bond B is greater due to less discontinuing over a shorter period. Bond B is less affected by interest rate risk, making it more attractive in stable market conditions. So when interest rate increase, the market price for both bonds it decrease. This inverse relationship occurs because new bonds are issued with higher yields, reducing the attractiveness of existing bonds. Longer term bonds like bond A experience greater price fluctuation and are more sensitive to interest rate changes. As a result, bond A will have a higher percentage price change than bond B. Let's consider a numerical example. Both bonds have a par value of $1,000 and a coupon rate of 5%. If interest rate rise from 5% to 6%, bond A's price decrease by approximately 14.5%, while bond B's price decreased by about 4.8%. This demonstrates the greater interest rate sensitivity of longer maturity bonds, which makes them riskier in rising rate environment. In anticipation of an economic slowdown, an effective bond investment strategy would include investing in shorter term bonds with maturities of 1 to 5 years, which are less sensitive to interest rate changes, prioritizing high credit quality bonds such as those rated AAA or AA to minimize credit risk and ensure investment safety, using a bond ladder strategy to diversify across different maturities and manage reinvestment risk, providing stability and predictability in your bond portfolio. So, to summarize, a shorter maturity bond trade at higher prices due to lower interest rate risk. This is an inverse relationship between bond prices and interest rate. Longer maturity bonds are more sensitive to interest rate changes, leading to greater price fluctuation. Understanding these relationship is essential for optimizing your bond portfolio and managing risk effectively. So, in conclusion, bond valuation is influenced significantly by time to maturity and interest rate changes. By applying these principles, investors can optimize their portfolios and manage risk effectively. As we face economic uncertainties, adopting a conservative bond investment strategy can safeguard against market volatility and align investments with financial goals. Thank you for your attention, and I'm open. Yep. Thank you.